Okay, good afternoon. I'm hanging out with my good friend, Cody Touchette, best loan officer in the world, and we're going to talk
In the
about,
whole world.
the whole world. We loan to the whole world. But I want to talk with Cody and get his wisdom on interest rates because the 10 years moving around. Buyers like, hey, where are things going? Sellers are like, where are things going? Both Cody and I are avid investors, so we're looking at where things are going. But I want to just start, Cody, real quick with this idea of like, what happened with the Federal Reserve as they lowered rates and then rates shot up, and now it looks like they've crested a little bit. Kind of walk us through what was happening there and your thoughts on the market for everyone.
Yeah. So, I mean, obviously we ran into really high inflation. And so the Federal Reserve had to make a move, right? That's their one tool, really. Their big sledgehammer of interest rates. They either whack them lower or they let them go higher based on what they want to do for the overall economy, right? And so we saw inflation tap out at like 9%. So the Fed had to raise interest rates, right? They had to calm down the economy. It worked, right? We got inflation back down to the mid twos. That's where we wanted to see things. And then they said about maybe around this time last year, right? Like I think it was right around Halloween of last year where they said, okay, I think we're done raising interest rates. As a matter of fact, next year, we're going to probably start to lower interest rates. We were in the vanilla flavored 30-year fixed mortgage world. October last year, we were almost at 8%, right? For an 8% 30-year fixed vanilla flavored mortgage, right? From there, over the next 2 months, before the Fed did anything, no active moves, right? They just talked about what they were going to do. We saw rates get better by a full percentage point, right? We went from 8 to 7 in 60 days with no actual move, just the promise of down the road, we're going to probably lower interest rates, right? So then we get into 2024, January, February, March, April, May, June, no rate cuts, right? We saw zero in the first half of the year. And we're like, okay, Fed, like what's up, right? When are we going to see some rate cuts?
You're like, bro, you promised me something.
Right. Yeah, exactly. Oh man. There's a lot of stories around there. But then I think it was like September, right? We got our first rate cut in September. Everybody's like, oh, hallelujah. And of course, everybody that's in process right then and there said, okay, great. My rate's 0.5% lower on my 30-year fixed rate mortgage, right?
Yeah.
No, unfortunately, the Fed controls the Fed funds rate. That's the rate at which banks lend to each other overnight, right? Like 8, 9, 10 hours. We're lending for 30 years, right? Different span of time. So then the interesting thing is how the correlation between, I guess we'll get to that in a second, but it is, okay. So we saw rates come down, right? Rates were coming down. We were at like 6% for a national average, waiting bated breath right as we were going about 2-3 weeks before the election. We're like flirting with 5.99, right? Like we're seeing, like we're going to see something start with a 5 here very soon. And then the market decided that 2-3 weeks before the election, they thought Donald Trump was going to win the election. And so they started pricing in a Trump victory. And, in the mortgage world, we're kind of like, what are you guys doing? Like, why would this? No, don't do that. Don't do that. Right. We're starting to see things creep up now. And we got back up into the like 6.5 range. We're like, oh man, we were so close to 5 something. And then the election hit. And what do you know? The market was right. The market knew it weeks before. And here we go. We got a Donald Trump presidency. The stock market goes bonkers. People tend to flock out of secure, safe investments and go into the market when that happens. So we saw people selling off their bonds, selling off their mortgage-backed securities because they wanted to get more money in the stock market. And as we see that happen, we see the price pressure go down as more and more people want to sell something. The price of a mortgage-backed security goes down, and thus the yield or the interest rate goes up. So, that was kind of a doubling effect because there's this FOMO moment, right? There's one, hey, if inflation goes up, the value of my bond or my mortgage-backed security might not be as valuable. But then there's the FOMO moment of, man, those guys in the stock market are doing really well. I want a piece of that, right? So we kind of had a doubling effect. And then all of a sudden, now we're back up at about 7%, right? So we were flirting with 5 something, solidly in the bottom 6s, and then we're back up to 7 1/8, 7 1/4, all as a result of, the election.
And then and then I want to go through that real quick. So as we're talking about the election, and the bond market is obviously calling it early, they're like, hey, Trump's going to win. Why did rates shoot up because of that Trump victory? What was the bond market anticipating in relation to that?
Right. So the market's anticipating more inflationary type policies, right?
Yep.
And so I don't know if that's true or not, right? I don't want to get into a Donald Trump, Joe Biden, Kamala Harris debate, right? But like the market, not me, not Cody, not Anton, the market thinks Donald Trump's policies will be more inflationary. And if there's more inflation, the Federal Reserve will not have to lower interest rates at the same pace that they were otherwise forecasting. And so, we have what's called the Fed dot plot, right? I know we've talked about this several times, right? Last year, about this time, the Fed came out with their dot plot. And their dot plot basically was forecasting they were going to lower interest rates by 0.75% to 1% in 2024, another full percentage point in 2025, another full percentage point in 2026, right? So we're staring down the barrel of 2.75 to 300 basis points in move, which, arguably if it's, that's about 2.5 to 3% in rates, right? In the next 2.5 years. So the market saw that and they're like, hallelujah, we're saved. Thank you very much. Now, those dot plots are probably not going to look the same when we see this Fed meeting here. December 17th is when the meetings start. December 18th at about 11 o'clock Pacific time is when they're going to give the results. And so we'll take a look at that dot plot and see what their forecast is for the rest of 25, 26, and into 27. And I got to believe that they will probably curtail some of those rate reductions that they were forecasting last year.
Brother, man, I feel like you and I are on the same page. I think that the market started pricing in that Trump victory, and they viewed that as inflationary. And the thing that I want all the listeners to understand here is inflation means the Fed can't lower rates. It means they won't provide lower rates. So if you look at the 10-year Treasury, and matter of fact, I want to share this real quick and throw this up on the screen. Share. Cool. If you look at the 10-year Treasury right there, this is what Cody was talking about. See, right there at the end of September, middle of September, we're hitting the lowest rates possible. Then all of a sudden we start pricing in this Trump victory. You see rates shoot up. You have the election right there, and then rates go up again.
Yep.
Now, my question, Cody, is because it looks like we've hit some type of a ceiling, some type of a resistance. It looks like it's in a channel kind of moving in a downward direction. Where do you think, and this is where I want the Cody crystal ball. Yeah. Where do you think this is going? And what are rates at approximately today so that people understand how much, because they've moved down significantly in the last 2 weeks.
They have. They absolutely have. Yeah.
Where did we get to? Where are they at today? And then what does this kind of look like maybe over the next 90 days, 6 months, and then historically?
Yeah. So I believe the reason for this kind of swing back is that the pendulum swing moment, right? Like things were getting really, really good. And then all of a sudden the pendulum hit and we're like, okay, hey, maybe that election is going to go the other direction than what somebody was thinking, right? So then it swings the opposite direction. And now we're kind of settling back down in here, right? And so I think it just was a little over exuberant, right? Again, that FOMO moment in the stock market, right? Like, I got to get in the stock market, and that's just when most retail traders just get hammered, right? They buy at the peak and sell at the bottom, right? Like that's it. God bless you if you're a better investor than me, but like I'm the same way, right? I'm like, oh my God, I got to get in this NVIDIA thing. And NVIDIA tops out and now it's down 15%, right? Like I'm always late to the party, right? And so, but that's what does that, right? That FOMO swing, and then all of a sudden it comes back to earth a little bit, right? You saw Bitcoin, right? Obviously Bitcoin went flying high to 104, 105. Now it's come back down a bit. That just will continue to happen. Oh, Anton, I lost you there. You still there, buddy? I'm sure he's coming back. Okay, there he is. So the 10-year Treasury and mortgage, right? That's a really interesting and fun thing to keep an eye on, right? And so the reason why I think personally, I think the 10-year Treasury is probably going to hang out in this zone for a while, right? We saw it bottom out recently at just under like 3.6, I think is where the bottom you mentioned in September, like 3.6 ish.
Yep.
We swung back up to like almost 4.5 at the peak in the last, in the last 3, 4, 5 weeks, right? So you go from, let's call it close to 3.5 to almost 4.5. Like that's 100 basis points, a 1% swing in the treasury. It wasn't quite 1%, but it was pretty close, right? And so think about being a home buyer in today's market, that whipsaw of, hey, rates are getting better, rates are getting better, rates are getting better. And then, because we had a little refinance blip, right? We always like to talk about the refinance bubble. Well, we had a refinance blip. There was about 30 days there where people were coming down from their 7.5s and 8.5s into 6.5 and maybe even 6, right? That's a very good refinance. You can drop 1 to 1.5%. You're usually happy camper, right? And so we locked a few. And we had a few that were kind of waiting, like, oh, well, what do you think the election's going to bring us? Well, it's anybody's game. And then it started to become pretty clear that the market was pricing in the election going the other direction, right? And so, I called, hey, we were at 6, now we're at 6.25. I think maybe we should lock this in and secure some of these gains, right? Save you $500 a month without any fee. And if it comes down, we'll just do it all again, right? We'll take another bite of the apple a year from now. No, I'm going to wait. Well, they waited from 6.25 and it went up to 7.25, right? And basically just took the refinance off the table for somebody coming from 7.5, right? Like it's not worth it now. Now we've gained a little back, right? We're probably national average like 6.7. That's a rough national average right now, right? And so the interesting thing there, and this is the point I was getting to, but I got a little excited. I had to go back a minute. That there's a spread between the 10-year treasury and the 30-year fixed rate mortgage. And it's been very dependable for a very long period of time. That spread was 1.75 to 200 basis points. So 175 to 200 basis points. So effectively, let's call it just 2, right? Two's easier. So if the 10-year treasury was at 2, then the 30-year fixed rate mortgage you'd expect to be at about 4, right? Yep. 2% above the treasury. So when the treasury goes up to 3, you'd expect about a 5% interest rate. But what happened was when things went so low, so fast, everybody's chasing that down. So that margin got deflated even a little more down to like 1.75. But then what happened was we saw inflation spike and we saw rates spike up, and mortgage companies said, whoa. Like we don't expect this to last very long. And it takes a mortgage company. Like I get paid when somebody closes a loan, right? Like that's how I get paid. Same thing with real estate. You get paid when they close. A mortgage company gets paid slowly over about 4 or 5 years, right? And so if they issue a mortgage that they don't expect to be on the books for more than a year because they think rates will come down, well, they need to stack in some profits up front, right? Because they don't figure that loan's going to hang out very long. And so what happened was we saw that normal margin of 200 basis points or 2% go up to about 3%, okay? And so now if you see a 10-year treasury at 4%, that's how we got to 7% interest rates, right? 100%. So coming back to our 10-year treasury, right, we saw it come back up to about 4.5. Well, we saw mortgage rates get up to like 7.25.
Yep.
So not quite 3%, but not 2 either. Now we've seen the treasury come back down to 4.2 is about where we're at today. 30-year fixed rate mortgage about 6.7. So that's a 250 basis point or a 2.5% premium over that 10-year treasury. So where I'm going with that is if we do see 10-year treasuries kind of level out, then I think the longer we have at those levels where it's level, then the more that margin is going to shrink back down closer to 200 basis points. So if we stay at 4.2 for a year, let's say nothing changes in all of 2025, right? And we know there'll be some ups and downs, but let's say it's just level for 2025. I could see those rates coming down from 6.7 down to 6.2, right? Getting back to a more normal margin just because we have some stability in the marketplace rather than the Fed making a bunch of moves or inflation going crazy or unemployment going crazy, right? Just some stability probably will get us closer back to the mean for that margin.
So the thing I want everyone thinking about, and the brilliance of what Cody just said there, is if unemployment, kind of keeps ticking up, if the GDP growth stays flat or slightly down. If inflation stays down, and then all of a sudden we're getting normal economic data that's just kind of plain vanilla. What that will allow lenders to do is it allow them to lower their part of that margin that they pass on to the buyer because there's less risk. And as they lower that margin, that could cause rates in itself to drop a half a point right there.
Yep.
So I want to switch mental gears for a second because I want to come back to this part. Fannie Mae's, I was like their CEO or someone high in the company, because I read the article this week. They said, don't expect rates to leave the sixes. We're at a historical norm for the last 40 years.
Yep.
What happened during COVID, that was abnormal. It was artificially pulled down. Therefore, get used to rates around sixes. Cody, what do you say when you hear stuff like that from Fannie Mae and what you're looking at with rates today? You know, what's like the range that you think they could be in, and what are they talking about?
Yeah, you bet. Well, so we follow forecasts pretty regularly, and those forecasts are always wrong, right? So like it's really hard to say because, I mean, who would have predicted a COVID event, right? Who would have, I mean, I guess some of us could have predicted the inflation going as high as they did when they turned on the money printers for as long as they did, right? But like some of these economic events or just global events are outside of anybody's purview, right? They're not going to see that coming, and you can't always see it coming. Now, that said, if we did just get some stability, then I think they're right. I think there's a very good chance that the 10-year just stays in this zone. I worry that it could actually get worse if some of the new political appointees and elected officials do some of the things that they're talking about, and it is inflationary. Now, again, I don't know if it will be, but in the past, those things have created some inflation, and that's why the market is banking on that. So if it does create more inflation, then the Fed may have no choice but to increase interest rates as well. Now, the interesting thing that you brought up too, that the Fed has a dual mandate, right? They've got two things they keep an eye on, and we've been focused heavily on inflation because that's the one that's been the buzzword, the big topic, right?
Yeah.
Because it got way out of control and now it's been in kind of brought back. But the other one is full employment, right? And so full employment, anything when unemployment ticks up over 4.1, 4.2, we start to worry like, hey, where are we at on jobs, right? And so if you saw inflation in check at 2.5%, but you saw unemployment tick up to 4.5, 4.6, the Fed's going to lower interest rates, right? They're going to spur on some economic growth, make it easier for companies to borrow money so they can go hire more employees, produce more widgets, and do their thing, right? And so if we don't see unemployment go up and we don't see inflation change much, then the Fed won't really have a reason to do anything. And if the Fed doesn't have a reason to do anything, then you probably won't see much change in the 10-year treasury, right? And so now there are some bigger economic forces at play, right? The 10-year treasury, we don't really think about like what that means, right? What that means is that's how much the company, the country is borrowing and how much they have to pay back, right? So more and more of our governmental notes are being paid off at 1% or 2%, and they're being issued again at 4 to 4.5%. And so when that happens, we're going to see a higher and higher bill come due on the interest that needs to be paid for by the government. So there may be some other factors that force their way into this equation of changing things for the better for company interest, if you will, right? So I don't know, right? So
because the debt is so big that our debt payments are surpassing defense spending.
Yes. Yeah. And it's not just because we've borrowed a lot more money, right? But it's not just because we borrow a lot more money, because if think about it from a family perspective, right? If you borrow your money for your mortgage, right? Your biggest housing or your biggest monthly expense, and you borrow at 2.75, and then you have to turn around and borrow the same amount of money at 7, well, your interest costs go way up, right? Now your principal and interest stays the same, your taxes stay the same. So it's not like a doubling, but like every 1% the rate moves is about a 10% increase in the cost on a mortgage, right? It's even more on a 10-year treasury because it's spread out over a shorter period of time than a mortgage. So yeah, I mean, there's going to be the piper needs to be paid on some of this debt as it starts to roll on more and more 4.5% debt and rolling off the 1% and 2% debt.
So you feel, so then Fannie Mae makes this prediction and says, hey, get used to rates in the sixes. And they reference, the long-term historical average, which essentially, if you look since the spike from the 80s to today, I mean, that average is around 6%. What are your feelings in regards to that?
Yeah, if you take the entire time that we've been tracking these and go back, the average is like 7.5, right? And so that's one thing that we talk about with our clients that maybe have only been thinking about buying a house over the last 5 years, right? Because this last 5 years has been a wild 5 years, not representative of the history, right? And so if we take a step up and we look at 10,000 foot and we say, okay, what's the history of interest rates? Yes, we need to consider the last 5 years, but let's also consider the previous 35 years. Well, anything in the sixes is spectacular. Yeah. Anything below 7.5 is below the mean, right? Is below the what we would have expected to get over that window of time. And so I guess what I would say is we got spoiled, right? Plain and simple, we got spoiled for a bit, right? The American consumer, real estate agents, mortgage loan officers, we all got spoiled with sub 4% interest rates. Any of those sub 4% rates were a gift. Hold on to them as long as you can, pay them as slow as you can, borrow money someplace else, right? And if we're buying new, right, we have to get used to this idea that this is the new norm, right? Like the 6 to 7% range is probably going to be our norm for a while until something happens, right? Until some major event changes. There could be anything, right? There could be a stock market crash. There could be another disease. There could be who knows, right? I mean, it's probably not even on our radar what's going to happen next that moves the markets, right? Zombie apocalypse. I don't know, right? Something's going to happen.
Yeah. So this is really what I wanted to get to. I think the rate range that we're most likely bound in for most of 2024 is that, let's call it 7 to max 5.75, unless the economy starts to massively degrade. And when you listen to the Federal Reserve, they were only talking about inflation. Now they're talking about unemployment. They came out, they talked their book. The unemployment numbers came out. They came out a little hotter than people wanted. And so then rates went down because of that. So as unemployment rises, that's one of those factors that could suck rates down. But I really feel like we'll probably spend most of 2024 in the mid sixes and possibly low sixes if we're lucky.
Yep.
I mean, is my logic flawed there? Am I missing anything, Cody? What are you thinking?
No, I think you're right. I mean, I think that's the exact right zone to think about. And, I guess what I would say is if somebody says, well, geez, I just can't do it because of that rate, like really reconsider, because I think that there's a good chance that this is where we're at for quite a while. And so you've got to think about all the other missed opportunities of not buying in today's market with, because if you're waiting for rates to get back sub 4, you might be waiting 30 years, right? Like, and by the time you get your sub 4% interest rate, you could already had your house paid off, right? Like literally that's how long it can take.
Yep.
Right. So and they say, when's the best time to to plant a tree? 20 years ago. When's the best time to buy real estate? 20 years ago. When's the second best time? Right now, today. And so if you truly can't afford it, I would say try to find a way to be able to afford it, because I think we're here for quite some time, probably 2, maybe 3 years. Beyond that, like you said, the crystal ball gets a little fuzzy beyond 2 years. And I could be totally wrong. Something could happen before the end of the year and we could be in the 5s by mid next year, right? I hope so. I hope it's not a terrible. The problem is that when we hope for better interest rates, we're hoping for something bad to happen generally.
Yeah.
Right.
Yeah. And I think that's what the average consumer is very much missing.
Yeah.
Low rates usually mean something catastrophic economically. And therefore, the reason rates haven't dropped is they don't have to, because we're not going through anything currently catastrophic. nor do you really want that to happen.
It's
And
true.
so one of the things for people to be thinking about, us as investors, we're always hunting for cash flow. First time home buyers, hey, how do I qualify? This is a time in the market when we've got to get a little bit more creative. We've got to work on buy downs. We've got to work on closing costs. Maybe we have to work on improving our credit, extra down payment, gift funds. What do we tell buyers, investors right now that, hey, it's just hard because, it's not affordable. What should they be thinking about?
Yeah, that's a great question. And actually, I was just talking to an investor client yesterday about that as well. A friend and investor client, and he's like, I just can't make sense of anything in today's market. And I said, well, what's your time horizon? And he's like, what do you mean? I was like, well, how long do you plan to hold it? Right? He's like, well, probably forever. Right? I'm investing this money and I'm going to use this for long-term cash flow in the future. I said, okay, well then let's look at it with a long-term time horizon, right? Because
beautiful. Yes.
Find something right now. Sure. Yeah. If you're negative cash flow of $500 a month, right? That like, oh, can't do it. Can't buy it. Well, okay. But it's a $700,000 house. And it's $700,000 house. Our forecasted appreciation rate for the next 12 months, around 7%, right? So if we get seven, and I don't know if that's right, but let's say we get 7% for argument's sake on 700,000, that's $49,000 a year in appreciation the first year.
Let's go.
So if you've got to feed this investment beast $500 a month, that's $6,000. If your company offered you a 401k where you could put $6,000 in and throughout the year, and at the end of the year, it'd be worth $49,000, would you think that's a good investment?
Well, what is that? Holy cow! Hold on. So open up the Magic Calculator app. Oh, it doesn't want to open for me. It's hating me right now. Open your phone. Tell me how much that is.
$49,000 divided by $6,000 is 816%.
So literally a better way to say this is, would you like to make 800% on your money?
Right. Yeah, exactly. And so I said, I get it, right? Nobody likes to feed an investment, right? You want to put money in and you want to get money out. Like that's how it's supposed to work. And what do we know about rent prices over time?
It just goes up.
Rent prices goes up, right? And if we're going to secure your investment property on a 30-year fixed rate mortgage at 7%, let's just say it's at 7%, right? So we're gonna close that loan at 7%. Cool. It'll never get worse than that. It could get better, right? Rates could get better. Maybe an event happens and we can refinance it, but let's not bank on that. Let's just know it's not going to get worse.
Yeah.
Right. And so then this year you're feeding it $500 a month. And if the rent on that was like $3,500, right? Let's say it goes up by 3% next year. That's $105 rent increase. So now you were feeding it $500 a month. Now you're feeding it $395 a month.
Yep.
The next year, now you're feeding it, let's call it, I don't know, $250, $275. So in 3 or 4 years, you're probably cash flow neutral. And in 30 years, you're making $5,000, $6,000 a month on that investment. And here's the other power of, this is my favorite thing in the world of finance, is the rule of 72.
Yep.
Right? So the rule of 72 states if you take 72 divided by your rate of return, that's how long it takes in years to make your money double. So let's take a really simple math equation here. If we got 7.2% rate of appreciation averaged over 30 years. Now, I'm not forecasting that. Don't get me wrong. I think in King County, our like 50 to 60 year appreciation is like 6.7, right? So it's close, but for the purpose of our example, let's just say it's 7.2. Then our money would double every 10 years, right? 72 divided by 7.2 just means 10. So that means looking forward, a $700,000 house in 10 years is worth 1.4, double. Now here's where it gets wild and wacky. And I don't know if this will come true, but like, this is a fun exercise. It goes from 700,000 to 1.4. 1.4 turns into 2.8. 2.8 turns into $5.6 million at the end of 30 years, right? I mean, here's the thing. Should we feed this investment $500 a month to be worth $5.6 million in 30 years? I think yes, right? Now, The other thing, maybe it's only every 15 years, right? That's really conservative for our neck of the woods, right? That's like a 5.4% rate of return. 700,000 to 1.4, 1.4 to 2.8. 2.8 is still pretty darn good in 30 years, feeding it $500 a month for the first few years, right? So my other favorite thing to do with that example is people think, Cody, you're nuts. Like there's no chance that a $700,000 house today is going to be worth 2.8 30 years from now, much less 5.6. Cool. Okay. So then let's go, like my favorite.
Let's go back in time.
I don't have a crystal ball, but I do have a rear view mirror. So let's look behind us instead. This split level house in Shoreline you're looking at buying at for 700,000, it's 60 years old. What did it sell for before, right? Mm-hmm. Let's go back 10, 15, 20, 30 years and see what it sold for 30 years ago. If it's 700 today, 15 years ago, let's use our 15-year example, right? 15 years ago, did it sell for 375? Well, let's see. Maybe it didn't sell. 30 years ago, did it sell for, I guess, 350? Did it sell for 175, right? 700 to 350, cut it in half again, 175. The answer is usually yes, right? If we go back 30 years, I could find that house that sold for a quarter of what it's worth today.
Absolutely. And so we should make it really clear for those of you that don't know, Cody and I both live in the Seattle Metro. And so and we're both hardcore investors and been in real estate for over 2 decades, both of us. And we've seen this play out. And we are in a high appreciation market that consistently goes through these numbers. And then I'm going to, on Friday at, when did I schedule that? Friday, I am doing a live at 11 a.m. Pacific, where I'm going to dig through those numbers. And so, Cody, the 10-year run in Snohomish County on the trend line was actually like 8.6. I mean, King County. So it's the last 10 years have been slightly above average, but you're correct. The ones before that. So I forecasted the regular trend line, and then I added 5% to it, and then I took 5% away. And even when you take 5% away, it still gives you a ridiculous number.
Yeah.
Off of the trend line.
Yeah. The King County average historical appreciation, 63 years, the stat is 5.74%.
Amazing.
And that's a double every 12 and a half years.
Amazing. So the question you should be asking yourself is, should I buy the investment? Should I possibly have a little bit of negative cash flow due to these high rates? Well, the answer is that's what we're doing with our money. Yeah. So we're currently, and we recorded a whole video about this, we're currently cycling our portfolios right now, even in this high interest rate environment. We're out there hunting for deals, making deals, both on like the land development side, on the value add side, because we know we can make them. And if they work in today's market, when rates come down, they just get even better.
That's right.
And one of the crazy things, because I saw Elias pop on here earlier, it reminded me, and I want to say this was 3 weeks ago, we got a first-time home buyer into a house for like $500, and they got $35,000 in credits, and then gift funds for the down payment. So no joke. People are like, it's unaffordable. This buyer in the last 30 days here in the Seattle Metro is purchasing a home for $500. Like, it's possible. Now, is that easy? Absolutely not. So it took a massively talented individual like Elias on our team to make that happen. But it's still possible. So, when the market's not perfect, we can go hunting for deals. We can go make deals. We can figure out ways to compensate for these higher interest rates, knowing that long-term appreciation is going to be amazing. To give you guys another real example, I bought a property in 2004 for $215,000, and that property's worth almost $700,000 today. I mean, I've already sold it and 1031 it into something else, but that was like the first rental property I purchased. And it's almost tripled since 2004. And it was just this beat up little Rambler that we bought.
And that's only 20 years, right?
And that's only 20 years.
Yep.
Okay. Now, part of that is what we talked about. That's that COVID money. Okay.
Sure.
So, let's assume that this appreciation doesn't keep going. So, Cody, is there anything that we should be watching for the, oh my goodness, watch for this, because then that's going to cause rates to shoot up? And conversely, is there an, oh my goodness, watch for this, because that's going to cause rates to go down?
Yeah. Well, I mean, we mentioned it, right? The two things that the Fed watches are unemployment and inflation. So those are the two things that we keep our really close eye on. Other than that, it would be some sort of, world event or, COVID type thing, and maybe an additional war, right? And again, generally speaking, what pushes rates lower is not good news, right? So we don't want to root for those things, right? And so honestly, I was thinking about this the other day with somebody. I was like, could we just make mortgage rates be 5%? Like it's always 5%, right? That's just the cost of borrowing if you want to buy a house. Maybe you pay a little more if you're going to buy as an investment property, right? The risk adjusters could be there, but the baseline mortgage is always the same, right? Let's just take that piece out of the equation. I thought that would be kind of interesting to do. Like, it would just give such stability to the housing market, and I think help with affordability. So I guess to answer your question, what to watch for is watch the unemployment numbers as they come out, right? The Fed's favorite measure of inflation is the producer price index, right? So watching that is important. CPI is important, but the PPI is the one that they really follow. Yeah. And, just keep an eye on those things. And if you see inflation start to tick up, then we've got to figure that the Fed is going to need to push that down as long as unemployment's remaining stable. If we see inflation go up and we see unemployment go up, well, then I don't know, right? We're probably going to see them have to really find a fine line and say, like, okay, what's impacting things the most, right? And so it would be interesting if they see less people have jobs, but prices still rise, right? Yeah. That puts the Fed in a quandary. Now, if we see the unemployment going up and inflation staying stable or going down, well, then good news. Like, the Fed's going to be able to lower interest rate. But the other side of that equation is bad news. Some of our friends lost their jobs, right? Like, there's people that we know that are out of work, and that's no fun for anybody, right? So again, it's hard to root for the economic events that will lead to lower and lower interest rates. I would think if we just get some stability in the marketplace, it will do wonders for all of us, I think.
I love it. No, and I totally agree there. Totally agree. How can people connect with you, Cody? And what states do you not do mortgages in? How's that?
We've got about 30 licenses. There's a few that we just can't. Like, New York is just a straight no. Utah and Colorado are very proud of their licensing requirements as well. So it's difficult to get there. But generally speaking, and Hawaii. Hawaii is another really tough one. But any one of those states that we are not licensed in, I've got a loan partner that is. And so typically what we'll do is, if somebody wants to talk to us about getting approved for buying a house or an investment property, we'll run through that whole process. And then if we do need to hand it to a partner that can get it closed in that state, then we can help them get it done. How to get a hold of us? TheTouchetteam.com is our website. My cell phone is 206-909-2007.
I love it. I love it. Hey, brother, man, thank you for dropping wisdom on us today and using some of your valuable time. I appreciate you.
Yeah, absolutely. Thanks for having me on, buddy. Always good talking to you.